As far as this desk is concerned, risk assets should be highly exposed right now after benefiting from the artificial support of central banks and governments for a near decade. While this has been the case for many months, the addition of a reversal of this process by way of monetary policy normalization and the addition of rising inflation have been the catalysts that are finally waking investors up to the reality that the game is up. What does this all mean? Well, we believe it should translate into something that looks a lot more like markets of old, markets that are more interested in moving on their own fundamentals than whatever may be going on over at the Fed. That should be a healthy thing, though the path to get there will come with pain as gravitational forces re-enter and send global equities into a free fall. We've had nothing but record highs in U.S. equities since 2013, and all of that accompanied by historically low volatility. It therefore stands to reason that the removal of such policy will inspire the opposite reaction of a reduction in risk appetite and surge in volatility. The S&P 500 is currently trading just under 2,700, and we believe there is risk for this market to trade back down towards the 2015 high over the coming months, which would take us back to around 2140 on the index, amounting to a reasonable 25% pullback off the record high from January. In our view, this is a conservative projection considering where we have been. As far as the FX side goes, it's a little trickier. The added variable of soft dollar policy and U.S. protectionism is something that cannot be taken lightly. And so traditional safe haven bids that would have been supportive of the U.S. dollar in a backdrop of risk liquidation may not be as supportive in this new world. But we believe the dollar will ultimately benefit on a broad basis despite the U.S. administration's policies. We may see the other major currencies share some of the risk-off inflow, but with these other currencies unlikely to welcome such appreciations, the dollar won't be able to turn away that demand. This is actually one of the reasons we also like the pound as a relative outperformer over the coming months, even with all the Brexit headaches. Ultimately, we believe those Brexit bumps will get smoothed out, and the market will be looking at a UK economy that has held up well over time with a stronger currency. The yen and Swiss franc will be interesting to watch. Both the BOJ and SNB will be very public about their displeasure with rallies in the yen and franc as risk comes off, though the BOJ may have an easier time convincing the market after the yen goes through a period of outperformance, perhaps resulting in dollar-yen back towards 100, given the fact that the yen really isn't a safe haven currency and is nothing more than a funding currency that will often be confused as a safe haven currency because of this. The SNB, however, will have a battle on its hands, and we're not sure how this will all play out as far as their massive exposure to U.S. equities go. Now, we don't expect a crisis in the currency like the one seen back in January 2015, but we do think the anticipated capitulation in risk assets will give the Swiss central bank a lot of stress. On the Thursday, we talked about those Ides of March, but perhaps it would be better to warn of those Ides of the rest of 2018. That's all for now.